Edward Silverstein, the convertible market, including your MainStay Convertible Fund, was flat to slightly down so far in 2015. Kind of follow the equity market. Is that your expectation for 2016 as well?
I would think so. Credit spreads have tightened enough that you're not going to get performance from convertibles from further credit spread tightening. Probably not going to get much in the way of downside from interest rates. So it's really dependent on what stocks do from here.
And will the Fed raising rates this week, it's a momentous week, have much of an impact on convertibles?
It did. Yesterday the market was up quite a bit because of the Fed move and the comments that went along with it. And convertibles captured the majority of that upside when stocks went higher. And we would expect similar performance going forward. If stocks work out, I think convertibles do very well. If stocks don't work out, the nice thing about convertibles is that they protect you on the downside. They'll pick up less of the downside move in equities.
And speaking of stocks, biotech stocks really got hammered this summer, a sharp downturn. One particular convertible issue that you like is BioMarin. Why do you like this one?
For several reasons. The stock went from 150 down to 100 where it is right now. The bonds give you a way to participate in the upside of the stock and protect you on the downside. BioMarin's a very interesting company in that it has 6 marketed drugs for rare orphan diseases. They also have a nice pipeline for similar type diseases. These are rare genetic disorders. We think some of them will be approved. We expect the company to be profitable in 2017. And with a convertible bond, if the stock moves higher, you'll participate in the vast majority of the upside of the stock. If for some reason these drugs don't come to pass, the ones that are in the pipeline, you're well protected on the downside. The bond matures in 3 years at par, and so the bonds probably wouldn't trade much below the $1,000 par value. The bonds are trading above par now, so you would lose that downside to par, but not nearly the extent of the downside that you would have with the equity.
And on the generic side, you like Teva Pharmaceuticals. Talk about this issue.
This one's interesting in several respects. The company just issued a convertible preferred with a 7% coupon. The common pays a 2% coupon, and so you're picking up 500 basis points, which is important in this environment of low yields. You're getting a nice yield, 7%, 500 basis points better than the common. The company's very interesting in several aspects, generate a significant amount of free cash flow. They're about to close on a $40 billion acquisition of Allergan's generic business. We think that further consolidation of the generic business is very good for pricing. The company also, despite being a generic company, has a branded pipeline. They have a drug that probably will be approved in about 6 months for Huntington's disease. They also have some other drugs in the pipeline, one for migraines, another for an oral form of multiple sclerosis treatment. And so I think there's a lot of catalysts there. The stock's very cheap at 12 times earnings, generates a lot of free cash flow. And we think that one has a limited downside and very good upside.
And then finally, in the energy sector, in the oil patch, you like Whiting Petroleum. Yeah. Clearly, energy stocks have just fallen off the table this year, including Whiting. Why do you like this particular credit?
This one's a little riskier than the others. Stock's gone from 90 down to 10. The bonds have gone from par down to $750, which kind of makes it interesting in the sense that the bonds mature in 2020, and so if the company can stay in business till then, which we expect it to, you have an 8% yield to maturity. Just if the stock does nothing but stay above zero, essentially, you'll have that 8% yield to maturity. We think the company will be in business in 5 years. We also think that oil will recover within the next several years. Company needs probably $50 oil to be profitable. We think the oil markets will change so that prices go higher as supply diminishes. As I mentioned, the stock's gone from 90 to 10. If the stock can recover to half its value and say go to 40, 45, these bonds will probably be worth about $1,200. And so you'd have probably about 60% upside in the bonds. As long as the company stays in business, your worst case is probably about 8% yield to maturity. We think it's a good risk-reward trade-off.
All right. Well, thanks a lot, Edward.
Thanks, Greg.
Thank you for watching The Street.